What's up, you guys? Zoeb here from OneGlanceTrader.com, and in this video I'll be taking a very popular options trading strategy for small accounts and showing you guys my kind of trading secrets of how I trade this particular strategy, which has allowed me to get some exceptional returns in a short space of time. And again, you can apply this to larger accounts, but the reason why I prefer using this for smaller accounts and why I teach it on my channel is because a lot of you guys are either A, starting out trading, or B, have under $1,000 to invest. And if I had $1,000 into the stock market or just to invest in general, and I wanted to beat the market of the standard S&P 500 8% returns, this is the type of strategy that I would employ. So if you like the sound of that, all I ask for is that you smash that like button and don't forget to subscribe. So just for proof as well that I'm actually using this strategy, I actually created a $500 small account challenge. And again, I'll link to that in the top right corner and will also be inside the description below. And just showing you guys full transparency of all the trades that I'm doing, and in a 2 month time frame from mid-November to mid-January, when you take into account commissions, I've made a 51% account growth gain. And again, I document the whole series. There's 5 episodes. Again, I strongly advise, if you want to see this in kind of real time, we'll be going through that inside that playlist. But what I'll do now is take you step by step in a bit more detail about the trading strategy, how to pick stocks, where to pick strike prices, all that kind of good stuff in this video. So step one is you need to have a broker, and obviously you need to fund the account. And again, I personally recommend, Interactive Brokers. That's who I use. They're not sponsored or anything inside this particular video. If you do click on the link and do sign up through the link down below, I do get paid a little small commission. But again, I use IB. If you're based in the US, there's Robinhood, there's Webull, there's Fidelity, there's Charles Schwab's. There's quite a number of them out there. It doesn't really matter. All you really need is a broker that allows you to trade options. So, get that step one. Most of you should already have this by now if you're watching this video. So, check out the link if you guys are interested. Step two is pick a stock that you're bullish on, right? And we'll go into the strategy inside the next slide, but this, you can apply the strategy I'm going to talk about in bear markets as well. But ideally, stocks go up, right? So we want to do this on bullish stocks, and it could be any stock. There are certain criteria I like to personally use. Again, I like to use household names or uh, companies that have been around and are showing, bullish tendencies. You can see here, 5-year chart on Microsoft. It's only going in one direction, right? You don't want a stock that's been, range bound or potentially going down and up. And I know you'll have, the pandemic, the V-shaped pandemic stuff inside there, but generally Microsoft has been on that uptrend, and you can see it's a beast. It's 2.3 trillion dollars, sorry, market cap. It's a very profitable company, just under 9. And what you really need in this strategy is volatility. And there's an average of 27 million shares traded every single day. So again, it could be in my $500 account challenge. I'm using Tesla because Tesla gives you slightly better premiums. But I'll show you in this particular example still how you can make some fairly decent money picking some very, very safe strike prices. So that's the first thing. Let's just you get a broker. Let's assume that we're going to be picking Microsoft as an example for this particular trade. The third thing is what we need to do is we need to pick a strike, and what a strike is the option price or the strike price of the actual stock market, or for this particular ticker symbol, in this case Microsoft. So if we have a look at the 4-hour chart that I've just taken a screenshot from TradingView, and again, TradingView in my view is free as well. Is one of the best charting packages out there, or web-based charting packages. And again, link to that is also down below as well if you're interested in having a look at TradingView. Don't worry about these green and green and red lines, all that kind of good stuff, because that's just one of the indicators that I've got on the platform. But the key thing here is finding a strike price um, where you don't think Microsoft will go in the next 3 to 4 weeks, right? And again, you'll see why I picked 3 to 4 weeks later on inside the next slide. But in this example here, you can see that the last major low was around $280, and the current share price at the time of this recording is around $310. So you can see here from where current price is to where Microsoft is, or the strike price we're thinking of 280, Microsoft has to drop roughly around 10% in the next 3 to 4 weeks, which, for a big, large cap like Microsoft, a 10% drop is quite a big drop for that company. So, you're putting the odds inside your favor is we don't want Microsoft to drop below $280 in the next 3 to 4 weeks. And the beauty about this strategy is, and I'll probably do a two-parter on this video is all about how to place that trade and the logic behind the trade. And the next step then really is kind of managing this trade. And you might think, oh, I've got to do a lot of managing of this trade. It's going to take a lot of my time. Trust me on this. Once you're done watching this video and the next video, um, you'll see how easy this is to manage, even when things start to go wrong. And that's what I love about this, is that with this particular strategy, even if Microsoft goes down, as long as it doesn't penetrate $280, you're still making money. And that's what I love about this. So pick a company, look at the chart. This is just basic support and resistance, taking the last major low. Um, and again, the reason why we want to choose this low is the assumption is if Microsoft starts to go down, it will then start to consolidate or use this line of support at this area, at least for a little while, giving you some opportunity to roll this position, which again we'll talk about inside the next video. So again, we're picking a fairly safe strike, in my opinion. Not to say it can't go down to $280. So once we've got the strike, what we want to do is we want to head into your platform, and this is just a screenshot of the interactive brokers options chain for Microsoft. And again, I'll just walk you through kind of how this position is built. And what we're doing here is this trading strategy we're going to use is spreads. And now there's two types of spreads. They're called different things. One is called a put credit spread, and a call credit spread. A put credit spread, which is what we're going to be doing now, is that you expect the price of a stock to go up, and a call credit spread is where you expect the price of the underlying to go down. So in this put credit spread example, the first thing you need to do is pick an expiration date. So you can see here at the top, you've got the $310, which is the current price of Microsoft at the time of this recording. And what you want to do is pick an expiration date around 4 weeks away, right? So when I'm shooting this video, or when the screenshot was taken, around 4 weeks is around February the 25th. And what we want to do is that we want to place two option positions inside the market. The first one is that we want to sell on the put side. If you're bullish on the stock, we want to sell the strike that we agreed on in the previous slide, which is 280. So you can see here, you select the 280. I want to sell one contract, and again, you can pick as many contracts as you want, expiring February 25th at the 280 strike. And over here, you've got the bid and the ask and the last price. And so basically, you'll be receiving a net credit of somewhere between 345 and $370. Because what you're saying here is that I'm willing to buy 100 shares of Microsoft at $280 per share. Now that actually equals to $280 $28,000, and you will receive a credit of between 345 and 370 to place that trade. Now, I don't know about you. I don't really want to put up $28,000 to buy Microsoft at 280. Don't get me wrong. $280 is probably a steal for Microsoft to go buy shares, but you know, I said that we're going to spend, a minimum of $500 on this particular trade, not $28,000 on this trade. So what we need to do is that we need to buy a put, which is I'm willing to um, uh, buy 100 shares um, of the underlying a one strike below the 280. So that would be the 275, and that basically is that you're buying the put for protection. So what will happen is if the price of Microsoft goes to 265 at the date of expiration, what will happen is that your broker will automatically execute the two trades together, which will give you a loss of the difference between your two strikes. So in this example here, 280 minus 275 is $5 per share times by 100 in the options market, so that's $500. So that's be your full collateral gone, wiped away. Now you might be thinking, why would I place that trade if there's risk in there? But we'll cover that inside the next video. So that's how you cap, so you don't have to pay $28,000 for the stock. Is that you buying the stock for 28 grand and then you're selling it for 275, 27,500, and therefore that's how you get to your $500 difference inside the loss, and your broker will take care of that. So what you're doing here, you're collecting premium between 345 and 370, and then you're using that premium to buy this put, which is lower than what you of the credit you received. So you're getting around whatever that the difference between those two, roughly around the midpoint, and you're buying it between 282 and 305. So what your broker has done is calculated that your estimated credit, so instead of getting $345 credit, you bought this put as protection, you're making a net credit of around 40 cents per share times by 100, so that's $40 net credit. So if we work it out, is that you're going to receive $40 credit divided by $500 collateral, which is the difference between your strikes. That equals an 8% return on your money. And I don't know about you, but placing one trade and in 4 weeks' time for you to make 8% return on your money, in my view, is a great trade on a reliable stock like Microsoft that has to drop by 10% for you to start potentially getting into trouble, right? As what I like to call it. So that's exactly what I've been doing for Tesla. So if we look back at the Tesla positions, is I've been, and let's go back here. I think I can go back slightly on this particular Tesla position. Again, if you're brand new to this, again, I urge you to kind of click the video down below. So in this Tesla example, let's go back to trade one actually, because trade one will explain it a lot better. So I sold the 900 put, and again, um, and then I received $1,488 in premium, but I used that premium to buy the 895 put for protection for $1,423. So you minus those two numbers together, that gives you a $65 difference. The difference between the two strikes is $5, and therefore that gives me a $500 collateral. So 65 divided by 500 gave me a 13% ROI, and therefore you see that that was the trade one. The commissions was $1.32, therefore giving me a net credit of 63.68, which was a 13% ROI. So that was trade one. And then as time goes on, if price goes against me or if price goes up, that option price of the option, the collective of that option will either go up or down depending on what happens with Tesla as time goes on, etc. And then what I do is I do what's called rolling the position. And what that basically means is I buy back those two options, or I buy back the collective option, and then I sell a new option to receive a net credit. And again, I'm not going to go through that in this video. What I'm going to do that is go through that in kind of the next part video, which again, if you're not subscribed, subscribe so you hit that bell notification so you guys receive when part two comes out. But this is basically what I've been doing over the last couple of months doing Tesla. 5 trades in 2 months. That all of those trades have probably taken me about 5 to 10 minutes in total to pick a new strike, to roll the position, all that kind of good stuff. Again, all done through the app and everything. So not too time consuming from my perspective, and grew the account by 50%. And again, didn't have to be $500. It could have been 1,000, 10,000, or whatever. The amount of effort you put in is not dictated by the amount of collateral that you've actually put in. The same amount of effort is actually needed. So again, hopefully this example is again just proving it doesn't need to be Tesla. It could be any stock that you are bullish on. You pick a strike price, you sell the put, then you buy a put at one increment below. Microsoft is a $5 increment, but there's a lot of stocks that have a $1 increment, so therefore it's $100 to put up. And again, with depending if your broker does pays for commissions and stuff, it may not be worth it because again you're going to be paying 2-3% inside commission, and you're only going to be making 6-7% on the return, so therefore 50% of your return is eaten up into commission, so it's not really worth it. You really want to be doing $200, $300, $400 plus collateral per trade to really make your commissions minimal to the overall amount. So again, what I've put on the screen now is my Tesla playlist, so you guys can see that in action. Again, make sure you like and subscribe to this video so you guys see it the next video, or where we go into okay, we'll have a look to see where Microsoft is inside the future, and then we'll look at what options we've got to roll this position to then generate more money. But what you're doing, you're investing your whole collateral in the position, and then you're going to buy back that option and then sell to open a new one and keep rolling your option every time, and hopefully you'll get a net credit every single time. Even if times you take a small loss, doesn't matter, because you're then going to keep going because you are assuming that the stock is going to continue to go up inside the long term. If you believe Microsoft's going to absolutely tank, then don't do the stock. So that's the way that this kind of approach works. So I really hope you enjoyed this video. Smash that like button, and I shall see you guys in the next video.